Good day, everyone, and welcome. My name is Dan Sampaio, and I'm delighted to open today's Mondat webinar in association with Sefton Fross, in which our panel will discuss the key considerations for a successful capital raise and what drives investor appetite. We are joined today by a brilliant panel. Badabo Adam Reilly is Director and Head of Investment Banking at Equity.The Capital Management. Badabo has over 15 years experience working on capital raising, corporate restructuring and M&A deals across multiple sectors and jurisdictions. Narinder Jugpal is a partner in the CMS Corporate Private Equity team and regularly advises private equity sponsors, financial institutions and corporates on all manner of domestic and cross-border acquisitions, disposals, restructurings and strategic joint ventures across a variety of industry sectors. Kemi Awadeen is Managing Director, Investment Banking at Chapel Hill Advisory Partners Limited. She has over 25 years of experience in investment banking and management. Kemi joined Chapel Hill in 2008 following the business combination with Denham, where she was involved in executing transactions including IPOs, privatization, equity raising and M&As. At Chapel Hill, Kemi has led many capital raising transactions for subnationals and corporates. She is keen on promoting sustainable financing. Kemi has very recently been appointed to chair the Mergers, Acquisition and Corporate Reorganisations Committee of a section of Business Law of the NBA. Saad Sheikh is a Principal of Investments at TLG Capital, Senior Member of the Investment Committee and heads portfolio operations across the firm's African interests. And completing today's panel is Olayemi Anyanechi. Olayemi is an award-winning corporate lawyer with 23 years of experience, most notably in sectors of banking and finance and energy and natural resources. She is also the founding partner of Sefton Fross, a globally acclaimed full-service law firm in Nigeria. Now, before we get started, here is how you can get involved in today's event. You have the opportunity to submit questions to today's presenters by typing them into the questions pane of the control panel. You may send in your questions at any time during the presentation and we'll address as many as possible during our Q&A session at the end of today's presentation. I would now like to hand you over to our speakers to begin today's webinar. Thank you.
Thank you very much, Dan. And to the participants, may I welcome you again to this webinar organized by Mondat in conjunction with Sefton Fross. Now, why are we here today? In its annual list of 10 predictions for 2021, the US-based capital raising firm, Expertspredict Capital, said 2021 is the most friendly environment for capital raising for hedge funds in years. Now, this analysis was contingent on three broad principles. The first is that there's been strong positive net asset flows. The second one is that there's been high activity, reallocation of staff due to high manager turnover. And also there's been a high manager research activity. And this positive outlook is actually what we are seeing in the capital markets globally. In fact, Financial Times, in discussing this issue, said that companies have raised $400 billion in the first 3 weeks of 2021 alone. They also noted that this figure is huge and is more than they have seen in the last 2 decades. And in fact, is 170 billion more that they've seen in that period on average. And of course, governments and central banks have also introduced stimuli to governments in order to rescue global economies. For Nigeria, it's been more or less the same. So we see large corporates going to the fixed income market, trying to refinance their debt, their working capital needs by issuing longer term loans and cheaper debt. So we felt that, perceptive companies should wonder, how can they benefit from this huge capital raising frenzy? Now, this is the background of what we're going to discuss with our panelists today. We're going to go through our panelists and ask, what is responsible for this fundraising spree? What is the status of PE investments in recent years? And how are PE investments, how are they going forward, even with the pandemic? We'll also ask our panelists, what are investors looking for? Why do they decide to do either debt, equity, or a mix of both? And what this pandemic has shown us is not just about investment, is how can you raise sustainable and resilient businesses. Our panelists will also share that idea with us. And of course, we will then ask the transaction advisors on the team, how do they contribute to putting together transactions to ensure that they get the sweeter deal? I'm going to start this conversation today with Narinda. Narinda, as Dan said, is a partner at CMS UK, and he has extensive experience in the private equity markets, both in Africa and internationally. So Narinda, please share your thoughts with us. What is responsible for this capital market frenzy? I mean, how are PE firms, how are they handling the issue, the ones that have already invested in companies? What are they doing? How has government stimuli, how has that contributed to the lack or the growth in our investment activity for 2021? And what do we expect going forward?
Thank you very much,
Narinda,
William.
we can't hear you.
I think to answer your question, I think from my perspective, I'll probably separate the last 12 months into two parts. I'd say the first part, which is really dealing with the immediate aftermath of the onset of the pandemic. And I think there, from a PE perspective and PE clients of ours, their focus was predominantly on liquidity and their portfolio, their existing portfolio businesses, and really ensuring that there was sufficient liquidity, or at least those companies had availability sufficient liquidity for the foreseeable future. And I suppose we saw three different things happening as a result of that. We saw portfolio companies drawing down under their debt facilities. We saw a number of portfolio companies taking advantage of state-backed schemes. For example, in the UK, the furlough scheme was very widely used. And further, for portfolio companies in sectors which were acutely exposed to the pandemic, we saw instances of the private equity investors themselves further capitalizing those portfolio companies. But I think there was a shift towards the second half of last year in particular, where, on a more positive note, I think we saw a number of our private equity investor clients returning to their bread and butter. And by that, what I really mean is, doing deals, doing investments, and executing buyouts. And the reasons for that, I suppose I'd make a few observations. The first is it's been well publicized that private equity is awash with lots of dry powder, and that remains to be the case. There is a lot of demand for assets, for investments and buyouts, and I'd say that's globally, and not just on the African continent. I think the second point I'd make is, some of our clients in that period did seek to be opportunistic. And that is seeking out opportunistic targets. And whilst we did see a few instances of that, I think perhaps not as much as was initially expected. And I think that's largely because a lot of what would be an opportunistic target was faring quite well as a result of state-backed support or support from their existing lenders. But I think that might well change in the next 6 to 12 months. And the third thing is we've just seen a lot of activity from private equity investors in certain sectors which continue to be hot sectors, so healthcare and technology. I think the last 6 months we've seen a lot of transactional activity. So to summarize, really, obviously the first few months very difficult on the onset of the pandemic, but subsequent to that, in many ways, has been a return to the deal doing that we've experienced in the past 2 years.
Thank you, Narinda. So my take from what you said is that there's been a lot more activity towards the end of last year, and that is because companies seem to need capital, opportunistic investments, but also seem to understand that, even though opportunistic, some of these investee companies, they manage to benefit from this investment because that was a lifesaver. Is that correct? I just want to clarify that to our participants before I go on.
Yeah, no, absolutely. I mean, there's twofold. We saw a lot of activity in sectors which benefited from the pandemic. So to give you an example of that, assets in the edtech space. So distant learning through electronic means. Obviously, in the pandemic, with a number of people working from home, demand for that service has gone through the roof. And we saw assets in that particular sector trading at 18+ times EBITDA, which, pre-academic, it probably would not have meant that level of valuation.
Okay, thank you. I know that a lot of Nigerian companies are going the tech way, so they may I'm sure they have a lot to take away from what you said. So there are lots of opportunities in that space. So this is opportunity for them to start looking. Having said that, I'm going to go right to Sad. So Sad, from what Narida said, a lot of opportunities for investment, especially in the health sector, the tech sector, the sectors that really benefit from this pandemic. But in making that investment, as an investor, what are you looking for? Why do you decide to invest in a company? Why do you take a decision between debt, equity, or a mix of both? What's the goal? What's the objective? Could you share that with the participants, please?
Of course, Yami. Thank you very much for having me. This is a very interesting discussion and something that we do day in, day out. I do agree with Narendra. There's a lot of dry powder in the market as a consequence of $9 trillion being pumped into various economies, coming up to $10 trillion. Now, that money has emerged in several key assets. Conventionally, you'd see inflation as a consequence. You don't see inflation as much in the Western markets as you see asset inflation. You'd see stock market at all-time highs. You see multiples being granted at all-time highs. So that's a consequence of the pandemic. But if you look at it from our perspective, last year, March, everything came to a grinding stop. The focus for us at that point was, will our portfolio companies survive? And we're a private equity, private debt fund. So it was imperative for us to demonstrate investor value throughout the process. Now, we offer to our investors regular dividends in the range of 8 to 10% annualized, payable quarterly. So one of the key decisions we made at that time was, because we were sitting on some cash, we paid out advanced dividends. So we paid out to our investors 12 months upfront dividends, giving us time to recuperate the capital from our investments, which meant that we wouldn't be hounding our investments as much as we would if we'd have to give quarterly payments. That said, the focus on the portfolio was immediate. We got working on the cash flows, trying to figure out how much cash is on the balance sheet, how much more is needed, best case, worst case scenarios. So I remember around May time evaluating what would happen if my businesses across the portfolio had zero revenue up until December. And there were three critical companies, two of which are unfortunately in Nigeria. Nigeria became a tough market, as you know. Dollar liquidity evaporated. We were in the midst of that. But just kind of running through that, I think it was a great experience, but two things came out of it. Investing in strong business models pays dividends. So thankfully, all our portfolio companies thrived, or at least survived, and then started to thrive in the latter part of last year. But we were also very, we were greatly warned by the idea that we had 3 exits in the second half of last year at very healthy valuations. One of them was at 35% IRR. So we ended the year on a very strong kind of tailwinds. The key challenge remained, how do we do more investments? Now that we're sitting on capital, how do we invest? The investment strategy for us has been critical to our success. Our track record demonstrates that our net yield on all our assets combined over the last 10 years is about 13% IRR in dollars. If you compare that to private equity investors, and AFCA has recently done a report, it's about 5% for private equity investors in the last 10 years. So our view was slightly different. We started as a permanent capital vehicle back in 2010, but very quickly realized equity can be very illiquid. And African entrepreneurs also don't like to give out large chunks of their equity. Now that landscape is changing very quickly in the tech sector and in the VC space. But if you look at conventional businesses, large corporates, they like to hold on to the equity and rather take debt. So we modulated our investment thesis into a debt with equity upside, which meant that our investment was protected on the downside through significant security, be it on the ground or some sort of credit notes, insurance grabs, guarantees, which gave us the comfort that our assets would continue to perform even in a downside scenario. But we didn't end there. We still think like equity investors, so we started taking equity upsides in terms of warrants, in terms of equity kickers, or shadow equity. Now, from an entrepreneur's perspective, if you're coming to us, we generally look at three verticals. We look at healthcare and health tech, financial inclusion, fintech, and the consumer sector. Now, consumer sector, you would assume it to be very broad. We do anything from manufacturing to retail to distribution, logistics, etc. So we've kept that angle fairly wide. The type of businesses we'd look at ideally have some sort of track record in EBITDA positive territory. They've proven their business model and they're generating bottom line. We've done some investments which are pre-EBITDA, i.e. they haven't broken even, but in that case, the business model is very sound, backed by very strong entrepreneurs, good Series A, Series B traction, more than $30 million raised in these rounds, and we'll go into those businesses. If I may throw a couple of examples, hoping that the audience is going to be well versed with Nigeria. We've invested in the pharmacy retail space, targeting the base of the pyramid. The reason being that space, in our view, is slightly underprivileged. They have access to fake drugs, etc. So we tried to modernize that space and clean it up a little bit. We have 7 pharmacies already with a consultancy product, but we're building or doubling that very soon. So we look at various business models as long as they fit our investment landscape. As Narinder said, we still have significant appetite for investments. We are sitting on some dry powder, but a key challenge for us is due diligence. We like our on-the-ground due diligence, and that has been hampered a little bit. So what we've done is we are in the process of negotiating term sheets, and once we're able to travel, we'll start deploying that capital. So I hope, Yemi, that answers the question. Happy to clarify if I've left anything.
Thank you, sir. That answers the question. You also answered questions that I had. I mean, I always wondered why we've never done any plain vanilla transaction with you. Your transactions are always very, very complicated, very, very sophisticated. So I get where that is coming from. I also now know that you do get a high IRR. So don't be surprised if I ask you for more money. That should also be down the line. So Kemi, in having this conversation, I've heard Sad say things like, they like companies that are paying well, they like good business models, they're focused on good entrepreneurship. So tell me, so one thing that's clear in making these investments is the type of company we have, performance. And historically, everything has just turned around performance management. But with the COVID pandemic, the world is trying to see that, business teachings have to go a little bit further, beyond performance to resilience. So what do you think assures a good growth and resilience in businesses? Could you just share that with the audience?
Okay, thank you very much, Yemi. And I think Narinder and Sad have set a good foundation. I think I'll make a couple of analogies as I answer the question on resilience. Yes, I think the focus for anyone, an investee company who is looking for a potential investor, first, what is top of mind is not necessarily resilience in terms of will the business survive if there's a huge, if there's an earthquake, if there's a business earthquake like had happened with the pandemic. I think what is top of mind when an investee company is looking for someone to partner with to grow their business or to start their business or to just do something different is that they're looking for, this is what I have, this is what I want to have funded. Secondly, they're looking for an investor who will go the long haul with them. And it was interesting to hear Sad talk about how they've managed some of their businesses given the unusual circumstances that we've had over the last 12 months almost. We're in February already. This all started in March. Because resilience, and I'll talk about the Nigerian in the Nigerian context, right? Resilience, you can only think about that if you know that something is coming. From the investor-investee relationship, I'll use an analogy like a marriage, right? You want this investor. The investor isn't going to be there forever. So it's not a marriage. It's a very strong friendship. It's a very strong relationship. And this investor is going to help you to grow your business, to do things with your business. But at the end of the day, this investor is looking for an exit. So this isn't a partner for life. And I think that needs to be top of mind as well, because at the point of investment, right, whilst you're thinking of just your the opportunity that will to enhance your business, right, the investor is thinking of the valuation, the pricing, at what price do I go in so that I meet my IRRs. Now, how do you build resilience into those competing viewpoints? Because on the one hand, I as an investor want to make a cheap investment. I as the investee company is looking for an opportunity where I make profit. And sometimes, the lines of profit, there's hardly any convergence. They're not necessarily a divergence, but at what, where do we, where's the commonality in what we're chasing? So I think, that's important. And then, post-investment, right? What are the things that will help us to navigate and create an opportunity to be resilient in the work that we're doing? So what are the things that we have agreed will occur if there is a problem, if cash flows, if revenues are hampered by an event? What will happen if there's an action that needs to be taken? What's that representation? How will that investor help me? And I think those are some of the things that will have to be looked out for in terms of building resilience into your business. And I think finally, right, I'd like to tongue-in-cheek speak of what I would call ROE. And ROE in this instance, not talking about return on equity or I'm talking about return on ego. So when you make that investment, right, in building that resilience, you want somebody to understand. So if we have an investor who is wielding a big stick, and you have an investee who's a very strong personality, then the opportunity to build a foundation that helps you to weather a storm, to help you go through a difficult period is not there. So for the investor and the investee, whilst there might be competing viewpoints in terms of this is my valuation, this is my return, these are my revenues, this is what I want out of this relationship, there still has to be a meeting of minds where we know that I know you're not here for the long haul, but I know that you'll be here to help me. And whether it's FX issues, talking about the Nigerian context, whether it's, I mean, COVID and the fallout of COVID has taught us different way of doing business. So do we have a business model that's nimble enough and will enable the investee look on the investor to help them chart a different path forward, but still maintain the core principles of that investment?
Thank you very much, Kemi. I've taken a lot away from you today. One of the biggest one is ROE, return on ego. I've never heard that before. And I think it will come in handy when I'm talking to my investee companies, because as you know, when you're working for the investor, I think it's a bit easier because you have the money, who pays the piper dictates the tune. I think the work really for advisors is working for investee companies and trying to persuade them that, okay, this looks a bit harsh, but it's good for you because, hey, it would help you manage your company better. It's a good monitoring tool and all that. So I will keep that word in case I need it, so I can just hit them on the head with it. And now I'll just go down to you, Gbadebo. So you are an advisor, you advise companies in both in capital raise exercise. So how do you put it all together? What do you do to ensure that you cut that sweet deal? How does your effort really matter? And what goes into transaction documents to make sure that, you know what, both parties have what they need without actually favoring one against the other, if at all that is possible?
Okay, thank you very much, Yemi. And I think your question would kind of allow me to put together a lot of things that Narinder, Fad, and Kemi have said. And I'm in line with what has been said. I think so in terms of how do we, facilitate the process, the investment process, so to speak. And I will use just the private company investment as a baseline. Now, this is what I'll walk through is just some form of template that can be molded and changed and amended as the case may be. Typically, you find that investee companies, the founders, the management, and all that, they will have varying levels of experience and exposure. But in the situation where this private company is looking for investment, we typically would advise. So you are essentially an outlet for capital injection. There is a lot of money, as we said, a lot of dry powder looking for the right investment. Now, an advisor comes in to sort of intermediate the real work, some additional work. Sometimes you don't need an advisor, but in most instances, I would say you would need an advisory team. So typically a financial advisor like ourselves and a legal advisor at the minimum, right? And they're just paying to work with the investee company to walk them through how they position themselves to be able to access the financing that is available. A few things, of course, there could be a number of the advisory teams could be larger than that, but these two are probably the most important, right? So first is, what's the key objective of this investee company? You're looking to raise financing. What kind of financing are you looking for? Are you looking for money to come into the company, or are you looking for some form of exit for maybe some of the shareholders or some of the promoters? So what we call primary or secondary, or you also call buyout or expansive, depending on what it is, right? But let's assume it's to expand the business, and getting a sense of what the objectives are. As advisors, we will do some form of internal diligence, what you call housekeeping. This is, as an advisor, you want to be sold on an opportunity first. So you want to also do some diligence to ensure that a number of things around company documentation, company financing, the records, taxes, and all that. You get some information, some base level information in place. You also study the business plan, but before that, you look at the sector with them, have an understanding of what is being sold, right? Where's this business? Because you need to be able to understand, you need to be sold on what you're selling as well, right? Because technically, while you're taking the investee company to the market, you are also selling the company, right? And on what I'll speak to would work for both investee companies and investors as well. The investors are largely aware of a number of these, but we move on to that to say, okay, what kind of financing are you looking for? So I've mentioned a number of different types of financing that will be required, but typically that's some work that is done at the back end with the company to say, what kind of funding are you looking at? What kind of what do you need in the short term, medium term, and longer term? And how would this be equity, debt? Would there be some form of hybrid? Is there a way we can make this sequential? And then we have a plan around where are we looking at? Are we looking at, let's assume, from an equity perspective, what kind of investors are we looking at? Are we looking at strategic investors, financial investors, or some kind of mix of both, or some companies that are or other forms of investors, right? But those are, most investors will fall within both either financial, which is where the institutional private equity type will fall in, or strategic, where you have someone else in the industry that's able to invest in you, and you'll be able to get some other strategic advantages from there. But largely, when you get to the point, so with the investee company now, you're trying to get a sense of do they have any views around it? Where they don't have any views around it, we look at what the strategic objectives are. We try and see what are the benefits. You find sometimes some financial institutions would also bring benefits that are typically found or typically obtainable with strategies, because they probably have invested in those kind of sectors in other jurisdictions, and they have some experience, some additional insights that they could bring on the table. But generally as well, you find a number of institutionals would have their sectors of interest. Now, these sectors of interest will change over time depending on depending on what's going on in the market from their own end. But typically, as advisors, you have a view around a number of potential investors and where their interests are. What are their sweet spots? What kind of amount are they looking at? What kind of instruments are they willing to commit to investment? And broadly, once you have a view around some of those, you'll now be able to get a view around what kind of process do you want to run? So you typically have either a bilateral process where the investee company is engaging with potential investors one-on-one or sequentially as you are, or some form of auction process, which will typically called a controlled auction, right? So at the extreme of that would be something in the range of a public auction, which is not necessarily mostly the case. But in a controlled auction, you find out you'll be able to shortlist a couple of potential investors, and you would be able to put information on the company to those investors. Now, coming to engage in the process of engaging the market or engaging these investors. Now, I'll use a two-stage process, which is kind of typical, but it could be amended to the peculiarity of the company in question. So essentially, what you really want to do is document the company as an advisor, document information about them, and provide that information to identified investors. As you do that, you give these identified investors enough time to understand this information, but there is a staged approach to it. You typically go with the teaser, end up with an information memorandum, allow them to do due diligence that takes them further down into the company. But there's a staged approach to this, and there is no one-size-fits-all. What the advisor will really do, or what the advisory team will really do, is work with the investee company and identify what will best suit your strategic objectives. You want to raise this capital? Do you have a time frame for it? What is underlying why you need to raise this capital? Is it your business expansion plan, or is it on the back of regulatory requirements? You walk around what suits them. Sometimes you find out that it could also be a sector where they've already identified, or there are one or two potential investors that it is easy to reach out to, and the likelihood of them, proceeding with this will be high. So you have some kind of bilateral engagement with those. At other instances, you have some form of controlled auction where you identify 3, 4, 5, 6 likely investors, and say, you reach out to these people first as an advisor and say, do you have interest in this? I have a client that has this need. We would have identified what the need is. Is it minority or majority stake that's being invested? And you get some form of expression of interest from them after you've shown them a teaser that just gives a highlight of what the company is about. Sometimes some company will say, we don't want all our information out. So there's a balance that's being you need to find there. So sometimes if you go with a no-name teaser and engage the investor universe, as you progress with those that are interested, you give more information, as we found in the confidential information memorandum, which will have information on the company, corporate profile, and governance information. So essentially at this stage, you're allowing the investor universe to do what you call desktop due diligence. So this due diligence that can be done, you can be sitting in the UK, the investor can be in the UK, the US, North America, South America, any part of the world, right? And they still have this information, access to this information. And typically after this, you give enough information to be able to allow an investor give an indication of how he values the company, right? Now, in the whole process of investing, some of the key points are valuation/pricing, right? You want to be able to give information that is enough for them to make a good call before they have detailed diligence. Now, also note that by the time you're inviting an investor to do diligence, proper diligence, they'll be incurring some costs because they would also have advisors on their end. We would also do some additional diligence, maybe diligence on ground. They'll have, typically, they also have advisors who would do diligence on the company. So you need to give enough information to give them comfort to decide that is this something of interest, is this something they're willing to commit some funds to see if at least express their interest further. We typically call it a non-binding bid as well. And typically you find after this round, right, an investee company will look at all the bids that we received. It could be one, it could be two, it could be three, it could be more than that, but typically just a small number so that you allow a very small number of potential investors go for due diligence. Now, in due diligence, there are a number of things that as advisors we factor in. So you need to factor the fact that you have a view around what this institutional investor, whether financial or strategic, are looking for. You try to make sure you have all those available in the data room as well. So be it from their financial, tax requirements, operational, commercial, technical, depending on what so it's really in preparation that you need to prepare the company to do this. Now, this is a lot of work in preparing companies, investee companies, but it's important investee companies have a view around it. And as due diligence proceeds, the key results from due diligence is, apart from maybe access to data room, there are many providers that allow remote access to data rooms where they can get that. Sometimes you also need to have some physical data rooms where investors will say, I need an advisor to go in, or I need to come in and speak with some people and look at some documents physically. Again, 2020 has taught us that we can do a lot more of that virtually, and I'm speaking about the pandemic as well. But even before the pandemic, there were a lot of virtual data rooms that are being used. There are a lot of deals that are being concluded, and we're doing a number of them fully virtually. But what the next step of just due diligence is really more like management meetings or what you call expert sessions, depending on the nature of the company. This allows investors to have
Do you mind if I just come in there? Because you've gone into a topic I thought I would find interesting, and there was a question from the audience I just wanted to pose to you. And because somebody from the audience wants to know how investment companies, do they have strategies where they relate with the community to identify potential viable businesses ideas to fund? I noticed that you had said earlier that sometimes you have clients, and when you have clients and people come to you for ideas, you then ask your clients, you have this transaction, do they want to fund? So for the participant that asked that question, Badebo has told us one thing. So for instance, if you know an advisory company, you know a Bativa, you know a Chapel Hill Denham, you can always go to them and say, you know what, I have this transaction, I'm looking for somebody to fund it. And of course, we lawyers to do that a lot. But now let me go to an investor that is here and then ask him, what is his strategy? And I'm getting about to come back to you because I would like to ask about, you mentioned due diligence, how do you mitigate the risks that you identify? I would like to ask that, but let me go to Sad first and say, Sad, in identifying potential businesses to fund, and this is from somebody in the audience, how do you identify those transactions and how do you go about prospecting them? Can you share that with us?
Oh yeah, I mean, it's a very important question, which is why we have friends like you in Nigeria and other countries, because you guys are our real kind of battleground. So we'll come to you and say, is there anything interesting given how well you know us? But also in the background, what we're doing in the office is two types of strategies. One, we have a top-down, where we're thinking about, for example, at the moment, what is really interesting to me is asset financing. So what I think about is what type of asset financing businesses exist on the African continent, then whittle it down to geographies that I'm interested in, and then start talking to them. So that's a top-down approach that I'll take. A thesis or thematic view that I have about the landscape, I'll go and try to invest in. Education, edtech, health tech, those are areas that I'm actively looking at. Cold chain, logistics, again, something that I'm looking at. So that's one approach. The other approach is we see a lot through our network, either brokers, Baribo is another example of organizations like Equity.The who will bring transactions to us, and that's the bottom up. Anything that comes to us, we'll then take it through a filter and say whether it works or not. And if it does work, then we take the conversation forward. But just to give your audience, Yemi, an idea, 90% of my transactions are based on direct contact with the company, and 10% is through people's introductions. Now, that will probably change as my fund grows. But the way that I've deployed the 150 so far is 90-odd% through direct contact, which means I like to be on the ground for a number of reasons. Either during due diligence, I meet a lot of companies, banks, other financial institutions, and try to figure out what deals I can get involved in, meet those people. Sometimes I've met those people 2 years ago, and they come back and say, by the way, now we're ready for your investment. So those are things that we keep an eye out for. So I would say slightly skewed towards own origination at the moment, but we do use organizations as well, especially like yourself. I mean, we come to you and always say, I mean, anything interesting that you've seen, please let us know. So it's contacts on the ground that we really look at to help us originate.
So where do you meet these contacts? Let me help my audience because they want to know. Where would you meet them, for instance? How do you normally meet these contacts on the ground? What do you do?
That's a very good question. So normally when I'm there, as you know, for two of my investments, let's say there's JC&Co Grace Lake, and then let's say there's Express Pharmacy. When I'm there, the first thing I'll do is, while even in London, I'll arrange meetings with most of the senior bankers that I know. At least for a day, I'll just meet banks. The next day, I'll meet all auditors. And based on those 2 days of contact, I'll at least have 3-4 meetings lined up with business owners. Then, given that I've done business in these countries, the entrepreneurs themselves will then link me up with other businesses. For example, the business partner we work with on the ground, he's introduced me to 4 or 5 deals. So that's another 4 or 5 meetings that I'll take. Then the auditors will meet 2 or 3 of the auditors and try to figure out, who are the best players in the market, which type of business models have they seen working effectively. They audit them so they know everything to do with the cash flows, and that's what we focus on. So that's one way of getting to know them. Then we genuinely meet these people, and in some cases even go down to their individual businesses, meet the higher management, just to get an initial sense of whether we can do this or not. Then come back to London, figure out next steps, and then go back in to kick the tires on the ground. So it's a repetitive process. It doesn't happen overnight, unfortunately. And I've been doing this for about 9 years now. So it's been a few years.
Thank you, Sam. I took a bit of time on that because I think that is what people really want to know. Before I come to Gbadebo, I'm going to go to Kemi. And this is why I think, because this is critical. We have just about 15 minutes. So please be brief so we can take all our questions and attend to all our issues before our time runs out. So Kemi, tell me, I heard Sad say it, and I think Gbadebo alluded to it. Management, governance, quality, the structure, the impact on quality and company valuations, right? Why is this so relevant? Why is management, why is it so key? Could you just share the idea with us so our audience, the ones that are investing companies, will know the things they need to, the kind of housekeeping they need to do?
Okay, so I mean, I think for me, right, that money will always chase good governance, and good governance may not exist on day one, but good money will chase good governance. Why is management important? So the business cannot run itself. The business is run by people. And so when SAD, for example, is looking to make an investment, the reason why he will go into the company is to get a look and feel of the people who are on the ground. So you want to know what their hard skills are, what's that qualification, and how will that qualification help the business grow. But even beyond that, right, there's also personality. Like, is this person the kind of person who, there's a meeting of minds, and that speaks to the governance in the transaction. So management is critical. Management is important because that's where also decisions are going to be made. That's where also ideas will be generated from. So it's extremely important that the management, even if at the beginning when Sad or Narinda take a view about a company, if management is not strong, but they can see that it has potential, then you begin to put the building blocks in place that would help you to achieve the sort of management and therefore driving the kind of governance that you're looking for.
Thank you very much, Kemi. So my take here is when investors are telling investing companies, I want this key man not to leave, I need you to hire a CFO, I need you to hire a CTO, is really because they want the growth of the company. So investing companies should stop thinking they want to take over their companies, correct? That's what you're telling me. It's because it's key. Thank you very much, Kemi.
Absolutely.
So before I go to Narinda, because that's a critical question. Yeah, I want to ask Narinda. And Gbadebo, that is, you've mentioned how to identify risk. Could you share how do you mitigate them? Because I imagine that when you identify this risk, you just don't abandon the transaction because it's risky, not necessarily. You then put some risk mitigation tools in place. So how do you do this? How do you get the deal to work, even though you've identified this risk?
Yeah,
Gbadebo,
I think
that's you.
I'll make a general comment on that.
But you can answer that if you want to.
Okay, Narinda, you can go and I'll add to it and I'll speak to you later.
I was just going to make a general observation that PE investors are realistic. They're not going to expect the governance arrangements of a business in the early stage of this investment cycle to be comparable to a public traded company, but there is a baseline expectation. And if you fall below that, then that flags a risk. Then sort of from a legal perspective, there's normally two places where you end up, possibly three. One is that it's protected against contractually, and we've heard sort of indemnification or some sort of warranties or rights. The second place, which is where you probably don't want to end up, is value erosion, where the risk is so significant that the investor says, well, hang on a minute, the price I said to you last week is no longer the price because the risk is so significant, I need to revisit the price. And that's not where you want to end up. So, to mitigate that risk, what do you do? And I would say, my advice and recommendation to anyone that's listening that's on the investee side is you have time, unless, if you plan to look for investment next year or some sort of exit strategy in the next year or two, I'd encourage you to do an audit now, identify the issues in your business, seek solutions or fixes to them to the extent you can, because what you don't want to have is, having gone all the way down to, down the road, down the path with one particular investor, and the risk comes to light at the end of the process, because then you're going to be in a situation where you're negotiating possibly both on price and also legally, from a legal perspective, some protection or controls you're going to have to give up in your business, which if you can fix at the outset, clearly you avoid that and you have a much smoother transaction.
Thank you, Narinda. So before Gbadebo asks, let me just say that you've answered a participant question even before I mentioned it, because he wanted to know whether investors are impatient with entrepreneurs that take their time to put their house in order. That was the question. So I guess the answer is not necessarily correct, Narinda. Investors are not, they're not ogres, so they look at your situation and sometimes they're willing to wait. Narinda, did I get that correct?
Yes, yeah, absolutely. I mean, the expectation is adjusted depending on.
But you had something to add. Do you want to share that before we go to the next question?
I think Narinda's response is fine. I think it's all in the planning. Like you said, it's all in the planning, both from the company perspective and the capital raise process. So you get your house in order, ensure things are in order, because essentially you're showcasing yourself as is, right? You're not adding any additional things to it. But once things are in order, you've done your audit, you've done your what you call some form of diagnostic test. Sometimes you need an independent person to do that for you. Sometimes you can do it yourself. Just doing your own housekeeping is probably some of the mitigating any form of risk and ensuring that what you are looking at, you are presenting your best foot forward, essentially. I think that's it.
Thank you, Gbadebo. I personally always advise my clients that invest in companies. I say, you know what? Do a legal audit, do a financial audit, do everything. Don't wait for people to come and do due diligence on you. Audit yourself, identify your risks, let your advisors take care of it for you. You would obviously get better terms, you get better valuation, you get better more interest. So I'd just like to leave that on the table. I have a question I'd like to ask, and this is because for me, I find that there are sometimes, other than the reps and warranties, which are critical in the documentation, when you're talking about institutional investors, financial investors, one thing that can be a bit difficult are those preferential rights. And also, Narinda, I'll throw this to you because, well, you're a lawyer, and then maybe I'll ask one of the finance people here to tell me these preferential rights, and I guess you know what I mean by that. Why are they so critical for the investors? Is there any that investors can say, you know what are the middle points? Could you just share your views with us on that?
Yeah, sure. So I think we've had a number of discussions around the actual structure of the investment from a private equity investor. And obviously, most of them will be, and touching on what Kemi said around commonality, they're going to be aligned with the existing shareholders in the business. They're going to participate in the growth alongside them. Our PE investors do not typically operationally get involved in the business, the operational side of the business. They leave that to the people that have grown it and know it incredibly well. So I'd say there's an overarching bucket of sort of preferential rights fall into largely around control. And another sort of point that was picked up earlier, which was around ego and the return on ego. Well, I think one of the things when it comes to preferential rights is striking the right balance. So the right balance between the people who are going to run the business, the management team, existing shareholders potentially, to do that, and then versus the investor who's going to write a check and want some protection in respect to that. So what does that mean? That means that there's going to be a number of things that they want control over, so things that you cannot do, that the business cannot do without getting their consent. Now, that shouldn't be an area of contention, but frequently it is. I think in that instance, it's important to be pragmatic. Touching on sort of downside protection, the investor will always look for some form of step-in rights. If things go really badly, they'll want to take control of the business. Again, the trigger for that, it's important from an investee company not to make that trigger too light, so that you're giving up control too easily. And I suppose the third thing is really, so going back to commonality, is acknowledging that both parties will participate in the growth. The question then becomes, okay, at what point does the exit happen? And that is another area where you will see the investor seeking effectively a preferential right to drive that exit process when they feel that the company is ready. It's got to a stage where it's grown organically or through acquisition, and they want to be in the driving seat when it comes to pushing the exit. And again, that is an area where existing shareholders and management teams may have their own views, but ultimately, it is something that an investor will most of the time insist on.
Thank you, Narinda.
So,
please go ahead.
No, sorry, I was going to say, does that answer your question, or would you like?
Yes, it does. It does, and I believe the audience too. They've gotten a lot of information from that. Please, if you have anything to add. But meanwhile, I have one other question. And Kemi, you left a lot of anecdotes that I like, and I'm going to keep using them. You did say that people must realize this is not a partnership for life. So you're talking exit. And I always know that those are also very, very interesting discussions. And, ultimately investing companies wonder, if I can't sell, why does he want to sell my company to somebody else? I'm like, because They tried to make you sell, but you couldn't. Could you explain what exit normally takes, and what is the rationale for investors wanting those exits and making it mandatory? Could you explain that, please? Hello, Kemi.
So I think I'll start by saying, and I think just maybe a reference to what Narinder was talking about, that we hear that he who pays the piper dictates the tune. But I think when it comes to investor and investees, they're actually singing from the same song sheet. And investing companies who are very keen to accept the investment from investors must also realize that investor has seen an opportunity and will help you grow that opportunity. But that money that was put into your company has to go somewhere else. They're not in it for forever. They may be in it for a long haul, 5 years, 7 years, whatever has been agreed. But they will take that money somewhere else to help somebody else. Now, in terms of what that exit will entail, that exit could be by way of a sale to somebody else and do a structure to another investor who will take the entire investment. That exit could be a listing, for example, on the stock exchange, and that may for the investee company create even more value for them in the long term and help the investor company achieve either their IRR or IRR plus from where they started when they first made that investment. So I think that what has to be not necessarily top of mind, but what the investee needs to understand is that when that investment comes in, that investment is not sitting there forever, and that investment will help you to grow your business, to help you to achieve some of the objectives that were contemplated at the point of investment. But that investor will leave at some point.
Thank you very much, Kemi. I have a question from one of the audience, and I'm going to just straight to the panel. Please feel free to just answer that. It's very, very interesting. Someone wants to air your views and thoughts on family-owned businesses. Are they easier to invest in? Do they have their peculiar challenges? And what would you be looking at in investing in a family-owned business? Could anybody just address that, please?
I'm happy to take it, at least a first stab. Family-owned businesses aren't any different to the other businesses that we've looked at, be it a partnership or a limited liability company. We've looked at businesses in the past that didn't even have incorporation, so they were sole traders. But as long as the business model makes sense, we're happy to incorporate the company. That's not the be-all, end-all. As you guys rightly pointed out, it's the team. It's the business.
Sorry, is that me? Can you guys hear me, or is that Sad?
I think Sad just got frozen.
Okay, could somebody else just share your views? Could you share your views while we're waiting for Sad to reconnect?
Okay, so
Yeah,
I think
sure.
I'll pick up from where Sad had left off to say that family-owned businesses are no different from any other business. It's a business model. We can see where the revenues are, we can see where the cash flows are. I think for me, what I find from experience is that there's a resistance from family-owned business, because whilst the business model may work, and whilst the business itself, has great potential, you have to begin to structure governance for them. You have to begin to structure management for them. And sometimes there's resistance on those two things is what I find.
Yeah, and just echo. I make the point that
I think it's just really succession. So if the family promoters, it's the key family members that are willing to have a deal come in. Sometimes you find out that they are looking at succession. That's the key thing that comes up in family businesses. So, but like last two speakers have said, it's a business as other businesses. But it has the peculiarities because there are also dynamics within different families. But you need to ensure that there is a homogeneous view around going forward, what plans about succession. Typically, when they're looking at succession, governance, and structure, better structure, that's when they look at investors coming in. And I think they'll benefit from a lot of institutional investors coming in and that whole process of stabilizing governance and management as well.
Okay, so let me now twist the question. What about, we're about to round up, so if you could just, in speaking, make this your last comments. What about family offices? So family offices, family investment companies, are they more flexible in negotiating terms with investee companies? So that's the reverse. So Sir, sorry we lost you. Thank you for coming back on. So I was just asking, I was flipping the question, and I was then asking about family-owned offices, family-owned investment companies. Are they easier to negotiate with investee companies? Still can't hear Sad. You know, I keep telling Sad he needs to move to Nigeria because he likes Nigeria so much. I can see that. I can see why. Sorry, Sad, can you speak up now? We couldn't hear you. We still can't hear him. Does anybody want to answer the question?
So I'll take that one, Liam.
Family offices
my experience of family
are less. Okay.
Sorry, I was just going to say that I think family offices, from my experience, have a different investment horizon versus more typical PE funds. And so they're willing to hold investments for longer. So I wouldn't say it makes it any easier in the negotiation, but they may take a much longer term view than a typical PE investor who's looking to exit in 3 to 5 years. They may well hold a business for 10 years. And a result of that, that means some of the things they will look for will be much more long term by necessity.
All right, thank you. So we have about 5 minutes. Could you share any last thoughts before we have to sign off? Any final thoughts before we say our goodbyes?
Okay, I think yeah. So I'll just make it very, very brief. I think the process of getting investors to come in from an investee company, there's a lot of work to do in positioning yourself well for an investor to come in. But it's not rocket science. It's typically investee companies have their focus areas. Most of them are have not been exposed to investor processes. But again, it's something that can be walked through. And like I think Sad and Narinda said earlier, sometimes these engagements can be with investors directly, but there's always some benefits to having some professionals work with you in preparing you to access capital from more institutional funders. I think that's really it.
Thank you, Gbadebo. Thank you very much for coming on board. Narinda, any final words?
Just that this sort of the relationship between investor plus investee company, I think the way to look at it is really one of partnership, because ultimately it needs to work both for the investor and the investee. And as when it comes to a negotiation, there needs to be a bit of give and take on both sides, because ultimately there is, going back to the earlier phrase, commonality in both parties looking to seek a successful investment and a successful exit.
Thank you. Kemi?
For entrepreneurs, they should have in mind from day one that this is a business that could be of great value in future. And so whilst they're focusing on growing their business and they have all the business ideas, it won't be out of place for them to surround themselves with 1 or 2 professionals who can continue to keep them smart, to keep them ready. And if there's ever an opportunity for a SAD to come in, for example, then the delta between where they are and what SAD is looking for is not seemingly insurmountable.
Thank you, Kemi. SAD, we would like to hear from you. I hope we can hear you now.
I don't know, can you?
Great. Yes, we can.
Oh, sincere apologies. Listen, this has been a phenomenal panel education for me as well. What we really hope is we can come across as investors with similar mindset as to the entrepreneurs. We want to work collaboratively with them. Working against the entrepreneur ends up into a health plus type of scenario where people are standing on the street and you're writing to the regulator. We'd rather not be in that situation. Our reputation matters a lot to us. So we want to be constructive and supportive to businesses. Our view is with our capital, business should grow. So hopefully we can make that happen in future as well.
Thank you, sir. Thank you to the panelists. I have learned a lot from all of you. And I believe that even the participants have taken away a lot as well. It's been a very, very innovative 1 hour. And let me just re-echo Gbadebo. Gbadebo took the words out of my mouth when he said, you know, sometimes you need people to help you walk the path. You need a financial advisor. You need a lawyer at the very least. That's really why I like being a lawyer, because, you know, one way or the other, you need us. And I'm sure Narinda would agree. And, you know, so when you do that and you start on a good path, then you can be sure that your transaction has a huge chance of success. So thank you, everybody. Thank you. I'm going to sign away here. Does my panelists, any of you have any last final words before we sign off? Thank you. It's been a pleasure having you and hosting this panel. Thank you and have a lovely day. Bye.
Thank you. Bye-bye.
Thank you. Bye.